Hey, welcome to The Explainer. Today, we are going to break down the wild world of cryptocurrency. Whether you're just a little bit curious or you're actually thinking about putting some money in, our goal here is simple: to give you a clear, solid guide so you can invest smart and, just as importantly, stay safe. All right, let's get into it. I'm sure you've heard the stories, right? People becoming millionaires overnight and other people losing absolutely everything. The hype is loud, but the fear is just as loud. So our job today is to cut through all of that noise and build a real foundation of knowledge so you can make your own informed decisions.
All right, so here's the game plan. First, we'll tackle what crypto even is. Then, we'll get you set up with the essential tools you're going to need. After that, we'll look at a few common ways people invest, dive deep into the really critical risks, and then we'll wrap up with the must-know rules for U.S. taxes and safety. Okay, let's dive right in. Before you even think about investing, you've got to understand what cryptocurrency and its underlying technology, the blockchain, actually are.
So, at its very core, cryptocurrency is just digital money. But here's the part that changes everything. It operates without a central authority. There's no single bank, no government controlling it. And that one idea, decentralization, is what makes it fundamentally different from any traditional money we've ever used.
So how does this whole thing actually work? Well, it's all powered by something called the blockchain, which you can think of as a giant shared public record book. When you want to send crypto, your request gets broadcast out to a global network of computers. These computers, or nodes, all work together to confirm the transaction is legit. Then they bundle it into a new block and permanently lock it onto the chain, creating the secure, unchangeable history of every transaction.
But you might be wondering, how do all those computers agree on what's real and what's not? Well, they use what are called consensus mechanisms. The original method, proof of work, is what Bitcoin uses. It involves miners using powerful computers to solve really complex puzzles. It's incredibly secure, but it uses a ton of energy. The newer model, proof of stake, which Ethereum now uses, has validators lock up their own coins as collateral to prove they're acting honestly. It's way more energy efficient, and it's where a lot of the industry is headed.
And it's really important to get this. Crypto is not just one thing. Not at all. It's this huge, sprawling ecosystem. You've got Bitcoin, the original, which a lot of people see as a store of value, kind of like digital gold. Then there's Ethereum, which is more like a global computer that lets people build all sorts of apps. Altcoins is basically the catch-all term for everything else. You've got stablecoins, which are designed to be stable and are pegged to something like the US dollar. And then, you have meme coins, which are incredibly risky and pretty much just run on social media hype.
Okay, so now that we've got the basics down, let's talk about the actual tools you're going to need to buy, sell, and store this stuff. This is your essential crypto toolkit.
The very first thing you're going to need is a wallet. And this is a really critical concept to understand. A crypto wallet doesn't actually hold your coins like a leather wallet holds cash. Your coins always exist on the blockchain. Your wallet just holds the secret keys that prove you're the owner. Think of it exactly like your bank account. Your wallet has two keys. The public key is like your account number. You can give it to anyone so they can send you money, no problem. But the private key, that's like your ATM PIN number. It gives anyone who has it total control. You must guard it with your life. I'm serious. Never, ever, under any circumstances, share it with anyone. So, when it comes to wallets, you've basically got two main flavors. Hot wallets are software. They're apps on your phone or computer. They're super convenient because they're always connected to the internet, but that connection also makes them more vulnerable to hackers. On the other hand, you have cold wallets. These are little physical hardware devices, like a USB drive, that keep your keys completely offline. They are, by far, the most secure way to store your crypto for the long term.
All right, the other big tool you'll need is an exchange. This is where you actually buy and sell. Now, for most people just starting out in the US, you're going to use a centralized exchange, or a CEX, like a Coinbase or a Kraken. They're pretty user-friendly, but the key thing is you're trusting them to hold your assets for you. The alternative is a decentralized exchange, or a DX, where you trade directly from your own wallet. It's a bit more complex, but you're always in complete control of your funds.
Okay, so you have the tools, you understand the basics, so now what? What's the actual game plan? There are a million different strategies out there, but let's just focus on a couple of the most common and sensible ones for beginners.
First up, you're going to hear this term a lot: HODL. And it literally started as a typo for hold in some old forum post, and it just stuck. It's a philosophy, really.
It just means you buy an asset you believe in for the long haul, and you hold on, no matter how crazy the price gets day to day. You're not trying to time the market, you're betting on the technology's long-term value.
Now this next one, dollar cost averaging, is probably one of the smartest things a new investor can do. Instead of trying to be a genius and find the perfect moment to buy, you just invest a set amount of money on a regular schedule, say $50 every Friday. Sometimes you'll buy high, sometimes you'll buy low, but over time it averages out. And the most important part? It takes the emotion out of investing.
So when you start thinking about building a portfolio, a lot of people recommend an approach like this, the core satellite model. The idea is that the big chunk of your investment, your core, is in the most established, well-known assets. In crypto, that's Bitcoin and Ethereum. Then a smaller satellite portion of your portfolio can be used for some riskier, but maybe promising altcoins or other speculative ideas.
All right, everybody, I need you to listen up. We've reached what is, without a doubt, the single most important section of this entire explainer. The potential rewards in crypto are obviously very high, but they are matched by enormous risks. Please, do not invest a single dollar until you truly understand what we're about to cover.
Look at that number. That is not a typo. During the 2018 crash, the price of Bitcoin fell by 84%. A lot of the smaller coins fell over 95% and just never came back. That is what volatility means in crypto. It is faster and way more brutal than the stock market. You have to be mentally prepared for the possibility of seeing your portfolio get cut in half or even worse.
And this number? This tells a completely different story. This isn't about the market price. This is the amount of money that was stolen from an exchange called MT back in 2014. At the time, it was the biggest exchange in the world, and it just collapsed, taking all of its customers' money with it. It's a lesson we've seen repeated with FTX. It shows that even the biggest platforms can fail catastrophically. That's counterparty risk.
So you see, the risk isn't just the price going down. You are in a constant 24/7 battle to just hold on to your stuff. Exchanges get hacked. Scammers built fake websites that look real to steal your password. And honestly, simple mistakes like sending your crypto to the wrong address or losing that little piece of paper with your password on it can mean your money is gone forever. No bank to call, no one to help you get it back.
So we can kind of lump all these dangers into three main buckets, right? You've got market risk. That's the crazy price swings. You have security risk. That's the constant threat from hackers and all sorts of sophisticated scams. And then there's regulatory risk. The laws around crypto are still being figured out, and a new rule from the government could pop up overnight and completely change the game for a particular asset.
And all of this brings us to probably the most famous saying in all of crypto: not your keys, not your coins. Here's what it means. If you leave your crypto on an exchange, you don't really own it. You're trusting that company. You have an IOU. True, absolute ownership means that you, and only you, are in control of your private keys, ideally stored safely offline on a cold wallet. Okay, for our last section, let's get into the nitty-gritty rules of the road for any US investor. Getting this stuff wrong can lead to serious headaches, so let's make sure we're clear on it.
So this is the question that trips up so many people when they're starting out. The thing is, the IRS does not see cryptocurrency as money. They treat it as property, just like a stock or a house. And that simple classification has huge consequences for your taxes.
This table right here is your best friend. Seriously, anytime you sell crypto back into dollars, that's a taxable event. If you use crypto to buy a coffee, technically that's a taxable event. And here's the one that gets everybody. Trading one crypto for another, say trading your Bitcoin for some Ethereum, is a taxable event. The IRS sees it as you selling the Bitcoin for a profit and then immediately buying Ethereum. On the flip side, just buying crypto with dollars or moving it between your own wallets is not taxable.
So how do you actually protect yourself? Here is your security checklist. Think of this as the absolute bare minimum. If you have any significant amount, get a hardware wallet. On all your accounts, use app-based two-factor authentication, not the one that sends you a text. And most important of all, when you set up a wallet, it gives you a secret recovery phrase. Write it down on paper, store it somewhere safe and physical, and never, ever save it on your computer or take a picture of it.
Look, the crypto world is absolutely crawling with scammers. Your best defense is a really good BS detector. If anyone ever promises you guaranteed high returns, it's a scam. If they're pressuring you to act right now, it's a scam. If someone claiming to be customer support slides into your DMs, it is a scam. Legitimate people and projects just don't operate that way. If you see these signs, you run.
So when you put it all together, your journey as a new investor should look something like this chart.
Your number one priority above all else has to be security. Right behind that is education, actually doing your own research to understand what you're buying. And way down at the bottom of the list should be chasing the latest hot thing you see on social media.
And that really brings us to the ultimate takeaway here. This is not a casino. It's not a get-rich-quick scheme. It's a long-term investment in a very volatile, brand-new technology. If you can approach it with patience, a real desire to learn, and a healthy dose of skepticism, you have a fighting chance. But if you come in with greed, looking for that instant jackpot, you are almost certainly going to get burned. Your mindset, more than anything, will be your single greatest asset on this journey.